Hey there, everyone. My name is Ryan Schul. Welcome to my analytics channel. So in the narrative today, I want to talk about foreign exchange analytics, and I'll preface this by saying that I am not a FX professional or trader or anything of that nature. Okay, I studied this stuff in grad school. I worked pretty close to FX people years ago, so I kind of know the ins and outs. I had to do a lot of research to prepare for this video, but I put in a lot of time. I think I did it justice. So I want to share my findings with you. And I'll also say, if you see a mistake in here somewhere, please highlight that, bring that to my attention in the comment section. And if you would think I did a good job and covered all the basis, and let me know about that too. So again, I think it's pretty much spot on. If there is a mistake in here, I do not know where it is. Okay, but if you find it, let me know. Okay, and again, this is not investment advice. I'm just looking at the statistics behind FX, right? All the mathematics, the data science, the computer science, the finance, the things like this, right? But it's not investment advice. So, what can we do with foreign exchange analytics? It gets very interesting. It gets kind of complicated too, okay? Because there's just a lot of moving parts here, okay? So let me take you through it. We can jump right into this. Basically, for US-based investor buying a foreign currency, anything out of the United States, the return will be 1 plus the local return times the FX end rate divided by the FX beginning rate, subtract 1. So a very simple way to look at this: if you trade Japanese yen and you sell it at 110 and you buy it at 100, you subtract 1 just to get this into a ratio, but it's always ending divided by beginning, right? So for any kind of investment return, that's how that's calculated. If you use FX or USD per $1 unit of foreign currency, if you only have the inverse, which is USD to JPY, so if USD comes first, this is the inverse quote. If USD comes second, this is the normal, straightforward, normal quote, okay? Now, personally, I think if it's the inverse, it would be the exact opposite of this, but that's probably why I never worked in the business, because I don't know, like my mind doesn't just naturally go to this place, right? But this is how it's done. So USD per Japanese yen is 1 divided USD by Japanese yen, right? So if we're doing GDP set up by the US investor, we could buy $1 million of British pounds, okay? This is, or UK pounds, whatever you want to call it, Great British pounds, at $1.30. The local market rises 10% to 1.1 million, right? So we go from 130 to 120. Now, in this case, the GDP depreciated in value, right? So this helps the US investor because now you can buy more GDP. It's actually cheaper, so you can buy more volume of this currency, right? So 1.1 million times 1.20 is 1.32, and the return times the change in a British pound, because it went from 130 to 120, is 0.9231 minus 1 equals 1.54%. So this is the headwind, right? This is the headwind if USD is stronger. It's stronger only because the British pound is getting weaker. It's depreciating, right? But if the USD is getting cheaper and you want to buy 100, you want to pay 1.30, $1.30 for 1 million British pounds, then it goes to 140. It appreciates in value. Okay, so it goes up 7.69%. Now it's 1.1 million times 1.4. That's the ending, right? That's the ending value. Remember, end divided by beginning. That's how we get the ending value. Now you have 1.54 million. You have to take that and convert that back to US dollars. You multiply by a smaller amount because the dollar went down relative to the pound going up, right? Here, the pound goes from a little bit cheaper to a little bit more expensive. Here, it's a little bit more expensive, a little bit cheaper. This is the mathematical operation here. 1.10 times 0.7 looks like 769. Minus 1 is 1.1%. Times 1.769. So now you actually have a higher return, right? So we went from 1.54% profit up to 18% profit. So that's why this kind of gets a little bit tricky, but you have to think about it. If your investment is appreciating, that's good for you. If your currency is depreciating, then that's bad for you. If they both appreciate, that's the best case scenario. If they both depreciate, you buy an asset at a certain price and then it depreciates in value. Now it's cheaper and your currency depreciates in value. You kind of get slammed twice there, right? So that's pretty painful. The best case is when both appreciate. Worst case is when both depreciate or move against you, and you have to remember which side of the coin you're on here, right? So for the U.S. investor, you want to appreciate currency, appreciate investment. In the U.S., if you're Japanese or Great Britain, then that's what you want, right? So it's relative to your local area. So another example here could be Japanese yen. We can buy 100 million worth of yen. Sounds like a lot. Remember, this is closer to probably 1 million because the currency rate would be maybe 110 or something to 1. Obviously, it changes all the time. I don't know what it is, but the Great British Pound to US dollars is relatively pretty close. Let me see, USD to GBP. Okay, so 0.74, and if we go the other way, GBP to USD would be the inverse of that, right? So 1.35. But then, of course, if you have the Japanese yen, Japanese yen, 199.37, right? So it sounds like it's a lot more. It's just the value of the currency, but you can see dollars to Great British Pound is closer to 1 to 1. This is 1 to 200, right? So you have to keep this in mind. So it sounds like we're buying a lot that is actually probably what would it be? 50 million? No, 500,000 USD, right? I think that's it, right? If you divide by 200. So we start with the USD cost. That would be 100 million divided by 110. Now in this case, you just saw it's 220, so it's a little bit different now. These numbers are a little bit dated. This would be about 500,000. The local market is up 5% to 105 million. So if you go from 110 to 130, the Japanese yen is depreciating about 15.38%. So 105 divided by 1.30, this is the ending value. Remember, that's how you do the math. You have 800,000 and you started with 900,000, right? So you made negative 11.11% return. The tailwind, if the US dollar is weaker, you go USD to Japanese yen. Now, remember, this is the inverse, right? This is the inverse investor, so you want this to depreciate. So it was 110, now it's 100. Japanese yen got 10% or appreciated 10% for the US investor. So it ended at 105, divide by 100. Now you have 100,000, 150,000, so your gain would be 15%, okay? So that's kind of like the basis for everything that I'm doing down here. So I took those points of logic, converted that to a Python script. We have our normal pandas, plotly, things like this, okay? So I'm gonna look at the local return, the FXstart, FXend, and are we looking at a direct quote or an inverse quote? So remember the first example, this is a direct quote. So this is Great British Pound to US dollar, that's a direct quote. This is an inverse quote, okay? So this would be USD per Japanese yen, and this would be GBP per Japanese yen, okay? So that's the concept here. We're doing some basic mathematical operations and determining, is this a headwind? And it's gonna help us, right, in certain scenarios, but not all. So if we are in an inverse scenario, an inverse headwind hurts us and the tailwind helps us, right? If we were in the standard direct quote, then the tailwind will help us and the headwind will hurt us, okay? So hopefully I said that right. I think so. Usually headwind, though, sorry, maybe I did misspeak. Usually the headwind is working against you, right? The tailwind is pushing you along, so it's helping push you into a better place. The headwind is pushing against you, right? So really you want to be in a position where you're getting these tailwinds. Of course, you don't know that when you set up these trades, and this can be either either one of two scenarios. Basically, you're trying to capitalize on a foreign currency price move that you expect. So this is really basically speculation. It's not even investing. Or you can use this maybe as an investment vehicle, although I think that's kind of rare. Most of the time it would be speculation or hedging your bet, right? So if you want to invest in foreign currency and you don't know which way it's going to go, you might create a hedge activity, right? So if the foreign currency depreciates and you're long that currency, you're going to have a hedge that offsets your losses, right? So you're going to make a small profit on the hedge, lose some money on the currency, but it's okay because you still kind of break even or close to breaking even. If you don't create that hedge, then you're in a painful spot because you're losing money with no money coming in, right? And the opposite would be speculation, where you just expect the currency to either appreciate or depreciate, and you engage in the appropriate activities here. So yeah, it's complicated, guys, I know, but hopefully I explained that fairly straightforward. So here's the scenario, kind of simple here. FXstart and FXend, that's what we're looking at. We have our calculation from the beginning. I showed you this over here, right? So USA return -1 plus return local times the FXend divided by the beginning -1 to get that into a ratio. So that's what you see here. That's what we're trying to return. And if I run the script, Control Enter to run this, we have the result. So GBP headwind, GBP tailwind, and you have 1.054. So that matches that. 0.1846. So those match. You have a headwind here. So this is hurting you a little bit. -11% and +15% with the tailwind. -11 and +15. Okay, so that's it. I think that's going in. I think we're headed in the right direction now. Kind of a simplified example, but hopefully, I've laid the groundwork and the foundation is in place here, and we can move forward. So it is complicated. I'm not trying to, dilute the complexity here or whatever. And I had to do a lot of research to put this together. So hopefully I got it right. I think I did. I didn't see any major mistakes here. Again, if you find one, please let me know. Okay, so here's another scenario. We're going to create a couple of heat maps so we can visualize this too. I always say a picture is worth 1,000 words. We're gonna go ahead and do kind of the same scenario that we just did before, but now we're gonna plot everything in a heat map. So the rows on the y-axis are really the assets, local currency return, and on the x-axis, I'm sorry, I said it wrong. On the y-axis is the vertical, right? The x-axis is the horizontal. The f-axis shows us the FX move, so this is a foreign exchange move, and the y-axis shows us the local currency return. So remember, if you invest in a foreign asset, you want that to appreciate, and you want your own currency to appreciate too, right? So you can buy more of the asset. So your currency is worth more than the other currency. You can buy more of that asset. If your local currency depreciates, you buy less of the asset, right? So if your currency depreciates and the value of the asset depreciates, you kind of get squeezed there. You want both to appreciate. So as we can see over here, this is all plotly, so we can see the bubble pop up here. I think this is called the tooltip. The USD return over here, the best scenario would be 0.38, where the X and the Y are both 20%, right? So the X, again, remember, is the FX move, and the Y-axis shows you the asset's local currency return. The worst place to be down here would be -15% and -20%. So you can see the best returns are on the northeast. The southwest represents the worst returns, okay? So if we look at this down here, now this is the inverse, right? This would be the direct quote. This would be the inverse quote. So direct quote is GBP. Great British Pound is stronger versus USD, boosts your USD return. Weaker GBP hurts, more blue on the left. USD to JPY, this is Japanese yen. Remember, if USD comes first, this is an inverse quote. If GDP comes first, then this is a direct quote. So if you have a direct trade with the other currency or the other country's currency, right, then you really want to be in the upper northeast area here, and then the southeast would be the most difficult place to be, correct? Because you're losing your shirt over here. If you have an indirect quote, then it's actually flipped, so everything is the opposite. So you want to be in this spot over here in the northwest of this chart, and in the southeast of the chart. Whoops, I don't know what that was. My news, I guess. Southeast part of the chart would be the worst place to be, okay? So I created another little heat map over here, Control Enter to run. Same concept, just slightly different view over here. This shows us GBP per US dollar, direct quote, okay? So again, northeast is the best place to be, southwest is the worst place to be, and for the inverse quote, the northwest would be the worst, I'm sorry, the best, that would be the best place, and southeast now is the worst, okay? Oh, did I say that right? Yeah, yes, okay. So I think that's good. Let me hit Control Enter to run this. And again, guys, it's kind of the same iteration over and over, just slightly different plots doing slightly different things, but the calculations and the concepts are virtually identical to the first thing I showed you. So now in this view, we can see x-axis shows the percent change of the FX quote. Again, dark red is better, dark blue is worse. The y-axis shows you the local currency asset returns. So again, dark red is where you want to be. This is a direct quote, GDP per US dollar. And with the Japanese yen, this is an indirect quote. So this is USD per Japanese yen. So everything just takes and gets just inverted to be the opposite, okay? So I have some notes down here. I don't think I'm going to go through everything. I don't want the video to drag on. And I think you can just read it. I got all this by Googling and working a little bit with ChatGPT. So I tried to reconcile everything and make this make sense. Hopefully it does. So again, if the USD comes second, then this is a direct quote. Okay, so this is Euro to USD. This is GBP to USD. If the USD comes first, this is an inverse quote. So this is Japanese yen and this is Canadian dollars, okay? So again, if GBP assets go up 10% and the currency appreciates from 1.3 to 1.4, the unhedged position is going to be 18.5%. The hedge is going to be up 10%. And you have a tailwind hit here, so you do have a small profit. It's this 18% minus this because the currency moved against you. Now it's getting more expensive, right? It went from $1.30 per Great British pound to now it's $1.40. If the Japanese yen goes from 110 to 130, that is depreciating in value. So the USD is getting stronger. The unhedged position goes from negative 11.1 to plus 5. You subtract the difference and you actually lose 16% because you have a headwind blowing against you. It's kind of pushing you back, right? So hopefully that makes sense. What's this last chart? Let me see. I was jumping around a little bit today with a couple other videos. Let me see. Okay, yeah. So we're looking at kind of a similar scenario using hedging, and I'm going to show you two different sort of outcomes, potential outcomes over here. So I want to change the volatility of the foreign exchange and the row, which would be the change of the, how's this defined? I have this in my notes down here. So the volatility measures the degree of the price variation for an asset or market over time. So volatility is sort of like the spread of the returns over time. If it's very volatile, it will have a very small spread. If it's highly volatile, it's going to be all over the place. You have a probability of getting a certain outcome here. Maybe in the normal distribution, it might be somewhat in the middle, but you could lose a ton, right, if things don't work out in your favor. So usually more variability is worse, although really you make all your returns from the volatility. If it doesn't really move a whole lot, you're not really going to make a whole lot. Okay, you just want this thing to move in your favor and not move against you. But again, you can't really control that, right? Because if you knew what was going to happen, if you know what the ultimate outcome is at the beginning, then everybody would be multi-billionaires, right? We don't know which direction these currency prices are going. So we try to control for the variation or the volatility or the standard deviation, right? called slightly different things, and the math is slightly different too, but it all represents the same thing, right? So you want to try to control for this variation, and the way to do that is by hedging, right? So if you think the foreign currency is going to depreciate, you would want to short that or not buy the foreign currency. If you think it's going to appreciate, you would want to buy that foreign currency. It's going to go up in time. But again, you don't know at the beginning. You don't know which way it's going to go. So that's the variation. The rho is the options price sensitivity to changes in the risk-free interest rate over time. So a 1% increase in interest rates means now interest rates are getting more expensive. It takes more money to borrow, right? If you have to borrow some of this capital to make your investments, now you have to pay a certain cost to the bank. It's going to be more expensive for borrowing this money, right? If you're cash rich, then this doesn't really matter because you can just dip into your coffers and just go ahead and pay. But a lot of companies either want to borrow if it's pretty cheap, or they just don't have the money to do the transaction, so they have to borrow. So the point is, I wanted to show you the difference. If you just toggle a couple parameters over here, the outcome can be drastically different, okay? So if the local asset changes, this is the standard deviation, around 18%, and the US dollar changes around 10%, and there is a small correlation, small negative correlation, then the unhedged and hedged position are going to be somewhat similar, right? So you can look at this normal distribution of the graph. You can zoom in here. That's why I love these plotly graphs. You can zoom in a little bit right here. You can see that the hedged and the unhedged are almost the same. I think the hedge is just slightly to the right of the unhedged, yes. So the hedged position, no, I said that wrong. The unhedged position is slightly to the right, but just pennies here to the right. Okay, then the unhedged position, did I say that right? Wait a second. Unhedged. That looks a little bit weird. Now that I zoom in on that, let me check that. When I wrap up this video, I'll look at that because it almost looks like the unhedged is blue and the hedged. Oh, it looks weird. I mean, I have to look at that. I have to look at that when this is done. Okay, so I'll come back to that. Anyways, the point is the standard deviation and the rho, which is the sensitivity of changing interest rates, right, is really not having a big impact on the outcome of this portfolio. You can see the distribution of the curve is fairly normal, fairly straightforward, and the hedged and the unhedged are almost in the same spot. Maybe there's some so close the graph is kind of overlaying them slightly differently. I have to look at that. But if you just change two parameters down here, so when I'm calling this up above, I think I use 0.1 and 0.2. Let me double check this. Yeah, so the volatility is 0.1, so 10%, and the rho is 0.2% negative. So again, this is the correlation and this is the volatility. If everything is exactly the same and you only change these two inputs right here, when I call the UDF above, this is the user-defined function, I'm going to pass in two variables that look like they don't really have a big impact, but actually have a massive impact on the outcome, the potential outcome of these investments in these hedged positions. So you can see everything is pretty tight and pretty packed in here with some deviation over to the side of this normal bell-shaped curve. I didn't change anything except for these two parameters right here. And now you can see the unhedged position is way beyond where the hedged position was. Okay, so just by changing these two features, you can see that this sort of concept, this construct is very volatile, and a small impact or a small change in the volatility or the rho of your portfolio can actually have a big impact on the final outcome, right? So just to change these two right here, if I put this down to 0.1 and 0.2, I think that's what the original was, you'll see a nice overlay with the hedged and the unhedged, right? These are pretty close right here. Change these two, 0.3 and I did 2.4. I meant to do 0.02. Do that again. Negative. That's negative 0.1 and 0.2. That should match exactly what I have above. And it looks pretty close. Change these two, and the outcome is totally and completely different now. Okay. So I would encourage you to take a look at this, dive in. If you want to change a couple other volatilities over here, by all means do it. These are just parameters that you're passing into the model that I created above. And if I do this, you'll see again, even a bigger. No, this is actually tighter now. This is actually a little bit tighter. So that's interesting. If we go down here, mu local, so this is actually muting it a little bit. But anyways, the point is to change those parameters and see what the final outcome is. 0.38. I think I had what did I have over here? Oh, this was 0.18. Okay, so if I make that smaller, 0.08. Now you see that the unhedged position is really dominating the hedge position. Okay, so let me flip that back. I'll keep it like that. I think that's fine. I think that's good because that's kind of what I wanted to illustrate too. Just if these positions are unhedged or hedged, with the hedge position, you have a lot more control on the distribution of potential outcomes, right? With the unhedged position, it can be all over the place, right? So you don't know what the returns are going to be. It could be massively positive to your benefit, right? If you end up down here on the positive end of the tail, right? But you can lose a ton if you end up back here. With the hedge position, everything is fairly protected for you, so the deviation cannot be that far. It has to be like somewhat close. It has to be somewhat close to the mean returns, right? Not deviating too much because these positions are hedged, right? The blue are the unhedged positions. Okay, so let's see what happened now. So the unhedged and hedge are fine. The hedge just shows you the distribution of return, and you can see the mean returns. They almost line up. The only difference here is with the unhedged, the outcome is anybody's guess, right? You have no idea what the final result is going to look like when these contracts expire, or when you decide to convert the currency back to your own currency, because eventually you have to do that. And again, you don't know what the outcome is going to be, right? You can make estimates, you can do calculations, and if I was doing this for real, I would look at probabilities. What's the most likely scenario? What's the second most likely? What's the third most likely? Things like that. We don't have actual historical data. I made up some of this data because I don't have access to it. So some of the numbers over here should be very, very realistic, but this didn't come from actual historical trades. These are numbers that I made up, right? So it should represent real world scenarios pretty accurately, but to get this very accurate, if you're going to try to generate profits or do this for yourself to really protect yourself, if you are dealing with foreign exchange, you really want to get actual historical numbers, check those trends over time. Again, I don't have access to that right now, so that's not really going to work out. But when you get these historical numbers, you can check, is the GBP going up or down? What's the trend for the last 3 months to 6 months to 12 months, things like that, and you can get a more accurate picture here. Again, I'm trying to illustrate the concept, the finance, the mathematics, the statistics, the data science and computer science, and all these things, right? Like I'm not putting this into production, and I'm not actually trading real money with it. I'm just trying to use this as an illustration and as a teaching opportunity. Okay, so there we go. I am going to download this right now, so you guys have all the HTML code, right? So you have exactly what I have. Let me save that. I will post that when I post a video later today. And that's pretty much it, guys. That's my take on foreign exchange analytics. Hopefully that was insightful and useful. And yeah, let me know in the comment section, if you think it's decent, if it could use some improvement. If I hit the target here and, delivered on all expectations, and let me know about that too. Okay, I'm going to wrap it up here. I'll post a video a little bit later today. I'll post all this source code so you have access to that. You can copy and paste it, and I think you're good to go. There you go, guys. I'm going to wrap it up here. Enjoy the rest of your day. Bye.